Gold breaks 2,600 on the back of the Fed's 50-point jumbo rate cut this past Wednesday, following the conclusion of the last three times the Fed cuts rates 50 basis points, the U.S. economy was headed for the rocks, which begs the question, is Jerome Powell and company panicking over the state of the U.S. labor market as they clearly pivot from their defense of inflation to a defense of the U.S. employment situation? In this gold market commentary for September 20th, 2024, I'll drill down on the changes in the labor market over just the last couple of months that have suddenly got the Fed so concerned, and how their pivot to labor could come at the detriment of inflation in the future as they go into an aggressive rate cutting cycle, and how this will benefit gold going forward. I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. Let me share my screen and I'll get on with our update. American Gold Exchange is a national physical precious metal and vintage U.S. gold and coin dealership operating out of Austin, Texas. If we can help you with your physical precious metals needs, whether you're buying or selling, we'd be happy to help you. In this gold market commentary, we're going to discuss why the Fed made a jumbo 50 basis point rate cut and why they're shifting their focus from inflation to employment. We'll look at how global tensions continue to increase, helping to fuel gold higher, and how the dollar and yields are testing new lows, helping to propel gold as well, which is why gold continues to set new all-time highs, and silver is now retesting a breakout over $29 an ounce. This is a graph of the federal funds rate going back to 2000, and you can see where the red circles are. The last time the Fed cut rates 50 basis points were because of the dot-com bubble burst, the great financial crisis of 2008, and the COVID explosion of 2020, which begs the question, why the sudden jumbo rate cut now when the economy is seemingly in a pretty good place, according to Jerome Powell? Let's take a look at what's happening with inflation first. And it is easing. This is a chart of the CPI going back to 2000, both the headline and core. And you can see headline CPI has tumbled. It's dropped from 2.9% just last month to 2.5% this month, while core CPI at 3.2% is holding steady. Some of that has to do with rents, which are being a bit sticky right now, and lag. And that's one of the reasons the Fed is cutting rates. We'll get into that in a little bit more. But part of the reason why the Fed is less concerned about inflation is that there's deflation in the global economy, in China and in Germany. Germany is weak as well, the economic engine of Europe. So when the world's largest economy is weak and in a deflationary spiral, and Europe's economic engine is weak, that'll help to translate lower prices into the US, which will help to ease inflation. But that comes with a caveat. This is a chart of China's economic wide prices, showing that they're in the longest decline since 1999 right now. And here's the crux of the problem for Jerome Powell and the Fed. The danger for China is deflation could snowball by encouraging households reeling from falling paychecks to cut back on spending or delay purchases because they expect prices to fall further. Corporate revenues will suffer, stifling investment and leading to further salary cuts and layoffs, bankrupting families and firms. This is what the Fed is trying to stave off: deflation. Inflation is much better for the economic situation that we're in with massive debt right now than deflation, which makes handling our excessive debt much more difficult. So that's really the crux of the problem for the Fed. And with the global economy as weak as it is, and inflation coming under and inflation taming in the US right now, the Fed has shifted gears towards employment. Let's drill down on employment. So this is a chart that shows from the Bureau of Labor Statistics the monthly job gains that are announced every month and the revisions that are shown as well. This goes back to January of 2023. you can see since December of 23, there's been a downward trend in the monthly job creation, and it's getting weaker. And the unemployment rate is rising from 3.7% to now 4.2% in August. San Francisco Fed Governor President Daley said that a couple months ago that the U.S. economy needs to generate about 230,000 jobs a month to keep unemployment stable. And clearly we're falling below that, which is why unemployment is rising. And I've highlighted that July bar to emphasize how revisions following the initial jobs gains report have been downward. In July, the initial job creation number was 114,000. But after the revision that came with the August job print, July was reduced down to 28,000, where the blue bar is. And in the last 13 of the last 14 months, we've seen downward revisions. So the initial reports are always a bit stronger than what's actually coming in behind the fact. And on top of that, we've had a massive 818,000 jobs revision between March of 2023 and March of 2024, based on the way the BLS surveys employers and the state unemployment insurance claims count employers. So let me explain how this goes. Every month, the BLS surveys a couple of 100,000 employers who represent millions of employers in the United States. And that's why the job creation numbers on a monthly basis, are a bit off and get revised once and then twice as time passes. So you get an initial report of jobs creation, then a first revision, and then a second revision. That revision I showed you for July was the first revision, down to 28,000 on the previous chart. However, the states have a much more precise way to count the actual number of jobs through their unemployment insurance claims, which have specific data from 97% of the employers in the United States. So they do this revision on an annual basis. So this year's revision, which was announced just before the Fed's August Jackson Hole, Wyoming meeting, was a massive 818,000 jobs lower. They're saying that the revision was unusually large, potentially due to the large influx of new immigrants into the country, which have skewed the numbers a bit. But in reality, this makes the net job revision between March of 23 and March of 24, 800,000 jobs, or from 2.9 million down to 2.1 million total jobs, or a reduction of 70,000 jobs a month, which is a ton. So let's look at that job chart again. This is before the revisions of March 23 to March 24. So you can see where we've been. Now, the Fed has not provided revisions in their BLS table yet. So I've made these revisions myself on the next chart so you can visually see what the changes are, taking those 70,000 jobs a month away in the March 23 to March 24 period. And this is what it looks like. Substantially fewer jobs overall, and well below the 230,000 a month that Fed Governor Daley says are necessary to keep the unemployment rate stable. Let's take one more look at that. Remember, the Fed got these numbers just before their Jackson Hole, Wyoming meeting, which was why Chairman Powell, I believe, said that they would go into a rate cut cycle starting at their September meeting, and why they've been aggressive with a 50 basis point rate cut. And this is the reasoning behind that. I watched Powell's press conference, and like a good doctor with a great bedside manner, he was very positive and very calm about the state of the US economy. But I believe that underlying this are some dangers, and they do too, which is why they've cut rates. Powell specifically said inflation risks are declining while employment risks are rising. 4.2% unemployment is still historically low, but job openings are falling. And this is the meat of the whole press conference. Further declines in job openings will translate into higher unemployment, which is what the Fed does not want. The economy is still facing higher prices, even though inflation is falling. And in my opinion, this is a proactive rate cut, which is very unusual by the Fed to try and get ahead of the curve, where they've been behind the curve in the past, as you know, and with projections of a further 1.5 of further rate cuts by the end of 2025, which would bring the federal funds rate down to about 3.25% by the end of 2025. But of course, that's all data dependent. So the Fed is trying to stimulate the economy or become less restrictive, as they like to say, to help spur job growth, which is the engine of the US economy. Remember, consumers spending is 70% of our economy. And as we've talked about in past updates, consumers are a bit spent. Look at credit card debt. This is total outstanding credit card balances going back to 2008. And we're at record highs right now at 1.142 trillion, with the average interest rate on those cards at 22.76% a month, which is astronomical compared to where we've been. So not only is the credit card debt at record highs, but the interest rate that consumers that hold this debt are paying on their credit cards is egregious. Another benefit from, consumers will benefit from this rate cut, allowing them to pay a little bit less to service that debt. And speaking of that, the Fed will get a break too, servicing their massive $35.4 trillion debt, which we now have, with an estimated interest expense now up to $948 trillion a year, with defense spending at $927 trillion. This is from the U.S. national debt clock. So the Fed's cutting rates, and cutting rates more aggressively than anyone thought they might, to quote unquote spur growth in the U.S. to the detriment of a potential reinflation of inflation. But this is going to be good for gold. As I've told you in our July 13th update, where I detailed specifically how this Fed rate cut would benefit gold, I showed you the last two times the Fed cut rates. This was a reasonably steady rate cut period, going from 5.25% to 2.25% in 2007, leading into 2008. That's before the GFC slashing of the rates. And gold gained 50% at that point in time, from 660 to 990. And again, during the rate cut cycle, pre-COVID and post-COVID, where the Fed was simply responding to a global economic slowdown and cut rates a 0.5 point then and 2/4 point cuts, gold gained 15%. But then when COVID hit, they slashed rates and gold gained another 23% very quickly, for a total of a 55% gain. So this rate cut phase that the Fed has now gone into, with an aggressive jumbo 50-point rate cut and more to follow, will help to buoy gold higher, as we've shown you, because gold likes cheaper money or lower rates. It doesn't have to compete for a yield as much, and especially when inflation is about the same as the interest rates, which is close on the treasury yields right now. Gold thrives in that kind of an environment. And speaking of gold, this is a chart of central bank gold demand going back to 2014, but it shows you the 2 years of 22 and 23 where central bank demand surged to record highs due to the weaponization of the dollar, as we discussed in our video titled Gold's Bullish Perfect Storm, laying out the factors that are driving gold to record highs. If you haven't seen that, you might want to take a look at that. The point of this chart is that in 2024, so far halfway through, according to the World Gold Council, physical demand for gold among central banks remains at record levels. So we're probably going to go over another 1,000 tons a year of central bank gold demand this year, helping to buoy the price further, which is puts it into record territory again. So physical demand for gold remains extremely strong. Meanwhile, the tinderbox that is the Ukraine war and the war between Israel and Iran in the Middle East just keeps fanning the flames higher, which is another reason why gold is pushing higher. Just in the last couple of weeks, the Ukraine has asked for offensive weapons so they can strike Russia at the heart of their war-making machine inside Russia's borders. And so far, we are resisting that. Vladimir Putin has said that that would be a declaration of war against the West, and it potentially, in his mind, puts nuclear weapons on the table, which would be horrific. And number two, the Israeli-Iran conflict has moved from the Gaza Strip now into Lebanon, and this sensational attack that Israel has perpetrated on the Lebanese Hezbollah military participants with their pager bombs and their walkie-talkie bombs has been amazing. And Hezbollah vows revenge. And I've seen a report that the Iranian ambassador to to Lebanon, was injured as well in that pager blowup. So the global conflicts that are helping to push gold higher as well show no signs of easing. This is a chart of the US dollar as measured against a basket of other currencies going back 1 year. And you can see the dollar tumbled on the back of weaker US economic data in August. And it's testing a bottom at 100.65, which is major 4-year support for the dollar. A break below that would put the 95 mark on the dollar index in play. And the dollar is certainly looking weak, and it will look weaker still if the US economy deteriorates. GDP was 3% in the second quarter, which is pretty strong, but Powell and company are rightfully concerned about employment creation because new job creation is slowing materially right now. Let's take a look at the yields. This is the 10-year Treasury yield, which has fallen to a low of 3.65, which again is a major support level going back about a year. It's just above a major support level, actually. It's bouncing just a bit above that. And you can see the federal funds rate in black. I've had to pencil that in, that rate cut in with that arrow off to the upper right because the chart hadn't updated that yet. So yields are tumbling and the dollar is tumbling. The gold price is inversely correlated to yields in the dollar. So if they fall further, that'll help to buoy gold. Oh, and here's another sign that the US economy may be in a bit of a squeeze right now, which is the uninversion of the 2 and the 10-year Treasury yields. You remember about 2 years ago when the 2-year went over the 10-year Treasury yield, creating the inversion in the first place. That is a remarkably consistent signal that a US recession is coming. Well, we've been in the longest inversion we've ever had, and now we've just seen the uninversion, which typically means the recession is here. And I'm not sure if this is another reason to give the Fed pause, but it might be. Typically, the uninversion occurs because the Fed slashes rates to stimulate the economy when the economy is headed into a period of weakness, which is why the uninversion typically coincides with the actual start of a recession. So time will tell on that one. All right, let's get to gold. This is a 1-year gold chart, and you can see how gold has just been relentless since it broke over 2050, since it ran from 2050 over previous highs of 2090 in the spring. We have set a series of higher highs and higher lows through August. And now as the US economy enters into that period of rate cuts, the gold price has been turbocharged. That first little arrow in July is when I advise you, hey, we are in the setup for the Fed to cut rates, and this is usually good for gold. And then that arrow in the August spot at about 25.50 is when we gave our update just before the Jackson Hole, Wyoming meeting, where I said, hey, the Fed could announce they will cut rates in September because they like to telegraph. And look what gold has done since we've issued those two updates. It's up about $225 from our July update and up another $100 now in the futures market. This is a chart of the futures market, which peaked at 26.47 just yesterday on Friday after the Fed cut rates. So that's the 1 year gold chart. Gold looks relentless. This puts 27.50 right into play, and $3,000 gold is just around the corner. It's only about another 15% gain from here, but gold has had a stunning 12-month period of a 34% gain through all of these changes over the last year, with the central bank buying, buoying gold, the conflict in the Middle East buoying gold, and now rate cuts in the US buoying gold. So gold looks relentless. It's one of the best performing assets of the year, and this trend looks to continue. Here's the 6-month candlestick chart, which shows you just how supportive gold is of this rise since about June 24th, after a consolidation period once it went over 2,300. This is as solid as you see a chart, and over the last 2 weeks, we've gone above trend as the Fed announced they would go into their rate cutting cycle, and that big spike the last 2 days show what's happened after the Fed actually cut rates. The little pin line just before that is the day they cut rates. So the gold market likes these lower rates, and we expect this to continue. Let's look at silver. This is a 1 year silver chart. And silver tried to break out earlier this year following the Hamas attack of Israel. It buoyed up, broke over 29 for the first time in May when gold took off. It's corrected back lower as of early August. It bottomed just under $27 an ounce, but now it's retesting its breakout over 29. And I continue to advocate buying silver while it's at these levels, because when silver plays catch up, it tends to play catch up with a vengeance. And I still believe silver should be $40 to $45 an ounce basis this gold price instead of $31.50, which is where it closed the futures market on Friday. Here is a 6-month candlestick chart, and you can see how the market came down. It's V'd, and now we've got a pretty strong move up. The last 3 ticks off to the right, the red tick is the Fed rate cut day, and then silver took a big bump up on Thursday, and then it moved higher again Friday, setting a high in the futures market at 31.75 before closing at about 31.50. So silver looks very solid again, testing a new breakout, and when it runs hot. So don't wait if you're interested in buying silver. This is a gold to silver ratio chart. The ratio remains high at about 84 to 1 today, with the spot price coming in at 26.20 and for gold and 31.25 for silver. The ratio dropped down to 73 earlier this year when silver took a run and then failed, and gold continued to go higher. Now it's back up to about 84 to 1. If the ratio brings it back down to about 62 to 1, that'll put it in the range that I've been discussing, $40 to $45 an ounce. So silver remains cheap relative to gold. And speaking of silver, if you're interested in silver, we have a special on 2023 leftover British Britannias, which we can offer as low as $2.79 over spot. This is a great value on a sovereign minted 1 ounce silver coin out of Great Britain. We have Silver Eagles. Our regular everyday low price right now is as low as $4.99 over spot. One of our major online competitors said they were having a special with Silver Eagles at $4.99 over spot. Well, that's our regular everyday price. So thank you for being our customer and paying attention to how we are competitive as much as possible all the time. And we also have a great gold special on a classic vintage European gold coin, the Napoleon III, 20 francs out of France, minted in the 1850s to 1870. These historic coins they're not rare, they're a little scarce, but we don't have to pay anybody to make them. So right now We have a little hoard of them that we found in the marketplace. We're offering them as low as 5% over gold value, which is as good as it gets for small trading sized physical gold coins. Once again, we're American Gold Exchange. We're a national physical precious metals dealer out of Austin, Texas. If we can help you, we'd love to. If you like the work that we're doing, please subscribe to our YouTube channel and like this video. You can find us on social media, on LinkedIn, on Instagram, and on X. And as always, I'd like to thank our loyal clients for the trust that you place in us and the business that you give us. Without our clients, we wouldn't have a business. And there's never a day that we don't remember that and are very thankful for what you've done for us over the last 26 years. We're approaching $2 billion in business, and we're looking forward to our next $2 billion. So thank you for your time today. That's our update. I think gold and silver are going to remain strong through the rest of this year, the way things are going. So if you're interested in buying, don't wait. If you're interested in selling, patience is a bit of a virtue right now. So thank you so much. Have a great day.